Hello and welcome to today's NCA webinar, Getting from Here to There, Planning and Budgeting in Times of Uncertainty. It's now my pleasure to introduce Henry Wallmeyer, NCA's President and CEO. Henry, if you're ready to begin, the floor is all yours.
Great. Thank you very much, John. I appreciate that. Welcome, everybody, to another very informative and wonderful webinar as part of our Town Hall series here. I'm not going to take too much time because I know we've got a lot of great things ahead of us with Frank and Ray and what they're going to be talking about. But I will encourage you, like I do, to visit our Coronavirus Resource Center. And I say this every day because we have new things up there every single day. And especially with regard to today's webinar, our financial and economic section is going to be the best place to get a lot of information for the things that we're talking about today. So if you have not been there, I would encourage you to do so, as you'll see a lot of things that are going to help you as we move forward during this time, as we hopefully can get from here to there and get on the other side with successful club operations. So with that, I'm going to turn it over to our moderator, Joe Trauger, NCA's Vice President of Government Relations. Take it away, Joe.
Thank you very much, Henry. And we'll go through government relations update fairly quickly as we do every day we do a webinar. Go ahead and advance the slide, John. Again, Congress right now is slated to return on April 20th. That date may actually slip depending on how things go. We're continuing to receive guidance and regulations from the Department of Treasury and the Small Business Administration. It seems like every day. I know that they released a new frequently asked questions document on the Paycheck Protection Program application and the program itself yesterday. And SBA is continuing to issue guidance as well on the program, as well as the Economic Injury Disaster Loan Program. The Phase 4 relief bill is still sort of being worked out. I think we're entering a different phase here, not only in the context of the previous three iterations and implementing those and getting those programs stood up and then get the money coming out the door or going out the door. But we're sort of in a space where Congress is out and they're trying to continue to address issues that come up with different areas and sectors of the economy. There was an effort today in the Senate to plus up the Paycheck Protection Program that was received $349 billion in the original CARES Act. They wanted to plus that up by about $250 billion to ensure that it doesn't run out of funds over the until Congress comes back. So that was attempted today. It was they're trying to do things by unanimous consent, and it was blocked or objected to by Minority Leader Chuck Schumer from New York, who has been in contact with and conversations with Speaker Nancy Pelosi about plussing up some other areas as well, namely hospitals and local governments, state and local governments. I think they want an additional $250 billion for those two pieces, so that would drive up the plus up to $500 billion. So unclear right now exactly how this is all going to play out, but we'll be on top of it and trying to see what opportunities are there. This particular plus up is not being considered phase 4. This is basically CARES, sort of just a plus up. The CARES 2.0 package is underway, being negotiated, and we are engaged with Congress and the Senate to see if we can get C7s included into the Paycheck Protection Program. That leads us into the contact your member of Congress and your senators portion of my presentation. And the main message here we're trying to get across is that it really shouldn't matter what type of organization a worker walks into when they show up to work. We're seeing a tremendous amount of layoffs in the club industry, and we should make sure that our workers are covered as well. So that's really the main message we're trying to get across to the senators and members of the House of Representatives. I will conclude by saying that we are also looking at potential regulatory or administrative fixes to get us included or be able to participate in the program. I've been reaching out to the Department of Treasury and the Small Business Administration. I did actually hear back from Treasury this morning, and not surprisingly, their initial answer is that they didn't think that there was a way they could do it administratively, but that's usually just the first response you get whenever you ask somebody to do something administratively. So we'll continue to push on that front as well, and like I said, continue the conversation with members of Congress and the Senate. So with that, we'll get into the meat of today's webinar. Very timely and important topics, and pleased to have Ray Cronin, founder and chief innovator with Club Benchmarking, and Frank Vane, president of McMahon Group, today. So, Frank, I believe you're up next.
Thank you, Joe, and good morning, everyone. Nice to be with you. Hope you are well and your families, and getting ready for a joyous Easter weekend. Today would be the first day of the Masters, so I have my Masters pullover on and thinking about that and thinking about the future, and that's really part of our conversation today. The challenges we face now, we do end up getting 2 Masters within 5 months, so think about how good that's going to be when that occurs. So there is something at the end of this, and that's really the key and the message today. We've all attended a lot of webinars recently and been heavily involved in this process. I think we're starting, it seems, to make a bit of a turn towards the future. And as Ray and I talked about today's agenda, that's certainly what we really wanted to emphasize, was this notion that a future is coming. And even though it is a time of uncertainty, that should not stop us from planning for the future. In fact, it really encourages to double down on that and make sure that we're planning effectively. As we look out there, of course, the pandemic will end, and we are in the midst of uncertainty right now. We don't know when that will occur. When it does occur, many things that have changed will quickly return back to normal. That certainly is one side of this. The other is some things that, may never go back to the way they were. We think back to times like 9/11 and after the 2007 recession and other momentous occasions in the country's history or economic history, and those things, certainly some of those are still with us today. We sit there today and we say, well, we don't really know which ones or when those will occur or what exactly those things will be. So there's a lot of questions, but we can't and should not let that uncertainty overwhelm us. Because in truth, we really, things are always less certain than we allow ourselves to believe. So when we think that we know what's going on, obviously there's other things that can come and derail us, just as we see with this occasion. And so it's important, again, to continue to look ahead. Many opinions out there about what's going to happen, of course, and different emotions and thoughts. I'm sure as you talk to your board members, your staff, your members at large, and thinking about the future, certainly some things we may subscribe to. Very likely that the pandemic, as we see here in that quote, the pandemic is almost sure to leave a mark on the way people work, shop, and socialize, perhaps permanently shifting the way many service industries operate. And we've certainly been in the crosshairs of this with the shelter in place and the lack of social gatherings. And as we've said on prior webinars, certainly the challenge of we're usually a place that people come and gather right away when there are times of trouble. And this time they've been unable to do that. They're going to come back to us, perhaps in a different form. On the other side, the world's full of opinions, or not. Is that really going to be the case? Some suggest, I'm going to go out on a limb here, I don't think much of anything will be changed forever, and I wish people would stop saying so based on 2 whole weeks of practicing isolation and social distancing. I don't know that I often look to Mother Jones for my quotes or thoughts on public policy or club business, but it's certainly a viewpoint that we'll hear out there and have to deal with and think about as we go to the future. But really the key is that when we look to perhaps the greatest planner of all time, right, Eisenhower, part of the savior of the world at really dark times, what is most likely is that, as he says here, in preparing for battle, I've always found that plans are useless, but planning is indispensable. Right? And so that's really the key, is to make that turn and begin thinking about planning for the future. Procrastination or failing the plan is really adopting an accidental strategy, an accidental outcome that will come out of that. What you really want to be is intentional. And even while there'll be some uncertainty about what you're doing or the environment that you're planning in, you really need to move ahead with a plan that's well constructed, thought out, based on research, based on good analysis that you have. Certainly Ray's the king of data and will bring us a lot of that sort of information to think about today. You want to use all that and make the best assumptions and the best judgments that you can going into this. Now, as we look out there and continue to do research and look at all sorts of different impacts that are out there and talk to clubs, club leaders, talk to members, you Led Zeppelin fans here will enjoy the title saying, well, really the song remains the same. We see nothing within this environment that's going to derail the macro trends that have been affecting clubs, and we anticipate affecting clubs going forward. And that really is this evolution from sort of a narrow and limited member experience to broad-based member experiences, thinking about everyone in the member household and how they benefit from the membership, versus our days going well back to limited sort of golf and male-centric kind of clubs that existed more in force in our economy. And we believe the watchwords remain, and we think that will be emphasized through these events around community. We're all starved for community now, and we'll really welcome that back. Family is obviously critical. We're closer to our families than ever through these events. A world that's going to be more casual. People are clearly looking for fun. We're more interested than ever now in fitness, health, wellness, all those factors going forward. All of those have been in play for clubs for a number of years now. They are going to be emphasized in this environment. And always in looking at these things, the key is your North Star in thinking through your planning is one of focused on quality, the quality of the experience and the services that you offer. The consistency. Consistency is going to be more vital than ever as members look to your club as the home away from home. They want to really feel safe there and secure there, and consistently of how you deliver services and what your programs are more important than ever. And then, of course, value of the experience in a different economic time and when people are seeking opportunities to engage with others and enjoy that. So when we see the major factors in place, we know that first and foremost, demographics are powerful forces, and nothing about the COVID event has changed demographics. When we look on our screen here, we see the United States population going back over the last century and looking at birth years there, the number of people that have been born in those periods, and you see the high watermarks on these charts here are both 1957 and 1990, right? The peaks of birth years in both the baby boom generation and among the millennial generation. And so the nadir, and I think one of the things that has been relatively underreported for clubs, is that in our business model where the primary joiners are between the ages of 35 and 45, we've had fewer people in those age groups over the last decade or so. And we believe they've contributed meaningfully to the decline in membership and the challenges that many clubs face. Our data shows that the average joiner of a country club today, thinking of the traditional clubs around the country, that it's a 42-year-old couple. They have a couple children. They were born around 1977. And so as we look out there, every year now for the next decade or more, the number of people between 35 and 45 is going to increase. This is very good news for clubs. This is the key opportunity that we face as a club community, that the number of people in the prime joining years is going to increase. That has nothing to do with the events of the pandemic or those sorts of things. It has to do with the reality of demographics and the opportunities those present to us. We are all, whatever kind of club we are and wherever we are within the country, we are going to have a larger addressable market year in, year out going forward. We believe that also that the blurring of the silos that have been occurring in lifestyles will be accelerated by the changes that are taking place. This means the opportunity to spend more time at the club. As we see out there that we lived a more rigid society in the past, where home and work and play were very separate entities in our lives, and our time was allocated more to each of those in different proportions throughout the day. And we enjoyed those, as we say, in really sort of a siloed environment. We had already been moving to a world where work and play and home were really all mixing together. All of us working out of our home offices at this point in time, and certainly the flexibility that comes with that, that is going to be accelerated by the events that are going on right now. People are enjoying this. Companies are going to see the advantages of doing this. Educators are changing the way that education will be happening as a result of this. This is also a critical opportunity for the club, as we say, as people have that flexibility in their lifestyle. They will be able to spend more time at their club as a result of that. They'll also want their club to work in ways that accommodates that change in their lifestyle. And we'll talk a little bit about some of those ways that clubs can do that. We see going forward the macro behavioral changes, and we have had events. While we can say that the pandemic is a bit unprecedented, the fact is that there was a major SARS event in Asia 17 years ago. There's also research and information coming from China today as to what's happening based upon the pandemic. And so we see a lot of that. A lot of pretense in society has been stripped away. We're looking at major CEOs doing webcasts from their basement and reporting out on CNBC and on staff and all those sorts of things. And so people, again, are approaching things a bit differently today. Following the COVID outbreak, we think it'll have broad implications on consumer behavior. First and foremost, a slower pace of life. Simpler will be better. Simpler is better in this environment. There will be more time and focus on individual and family well-being, smaller social circles, increased online connectivity throughout all this, whether it is for shopping, educating, working, friendships, or in fact our club. Remote work will become more common. Remote work will take place anywhere and could in fact take place in your club. There's more popularity of arts and crafts, and for many of you involved in enrichment activities, a lot of that is returning. A lot of the card games and bridge and instruction, it's all part of that. Cooking is more popular, and certainly increased focus on food safety and hygiene. Effective leaders must understand how these changes will impact their business, and they must innovate their way through these changes, responding to those and making our members comfortable in our club. Now we are approaching the time for clubs to shine. While the shelter in place has been difficult for us, whether it's May 1, whether it's June 1, that will begin to wind down. And what it is, our clubs will be able to be that first choice for our members. When economic activity returns, our clubs will be one of the first places that they want to go. The opportunity for clubs in this marketplace is that members are going to be reluctant to travel. They're going to stay close to home. All those trips to Europe that were canceled today, as I interview and talk to members now, they frequently tell me all the travel that they were planning to do for 2020 that's really off the charts. And so the idea is the club really can serve as that comfortable, trusted home away from home that they can go and enjoy. And it's our job to make our members feel as comfortable in their club as they would be at home. The staycation will be back in force. We want to emphasize the fact that we do have a private member enclave, that we have a knowledgeable, caring staff, and we also have a membership that cares about the health and well-being of that staff. We'll probably look at some medical officers being on staff and taking care of to check both member and staff as they come to the club and use the club. These are all advantages that you want to stress, and I suspect, although we have not heard much of it, in fact, I was talking with a club manager yesterday has more applications right now than they've had resignations over the last few weeks. So we think that some of the predictions about mass resignations of membership seem to be overblown. We also think that you'll want to help members think through these things as they talk about the potential of resigning from their club. You want to stress these features to those members. They may be making a hasty decision, maybe thinking that, again, the world is ending, and they may have some own challenges right now in their own businesses. While we certainly would never encourage the mass suspension of dues, certainly one of the watchwords in business today is forbearance, whether that's the banks or whether that's other organizations. I take the cues from things like when the IRS is letting you pay your taxes in July, we may want to be working with some portion of our membership in the element of forbearance as they deal with the challenges that they face right now and have the opportunity to come back at some other time. But when you're facing that member who's saying, we think this is a time to leave for our club, you may want to remind them how the club is going to be able to serve them extremely well in the months ahead. Obviously, as we look at this crisis, it's a bit unusual in the fact that there's no sort of all clear. It's going to be much more of a gradual awakening when you listen to folks like Dr. Fauci and others talk about that. And so people, again, are going to remain cautious. It will vary by region and certainly by club type. Country clubs have some opportunities that perhaps the urban city clubs do not, in the way that they may use their property, they may use their facilities. You'll have to take that on a case-by-case basis, but plan now for how you'll make your club that safe and secure place for your membership. Controlled entrances we see being part of this for a while. As I say, staff and member temperature taking being part of that. Smaller is better in terms of events, dining rooms and spaces like that. Limiting our guest access, limiting outside events for a while are all things we're going to want to consider. And again, in fact, emphasize for our membership as we think about opening up again and becoming active. It's extremely important as we approach the end of the cessation of activities that you refresh your strategy as you reset for this new world. Clubs made many, many mistakes in the 2007-2009 meltdown. Immediately cutting initiation fees, some even reduced dues and had various dues levels by newer and more seasoned members. They were eliminating general managers or mid-level staff to, quote, save money, chasing non-member activities or cutting services, going on defense, really, and really emphasizing cost over value. We must always remember we operate in the luxury end of the hospitality business. We are indeed a private club, and we're not going to get others to pay for that enjoyment. We need to provide value for our members so that they will pay their dues and enjoy their membership that way. So in this time, it's more important than ever to act in concert with your mission, your vision, and your values. And you do that by understanding the marketplace. Look at the lifestyle trends that are out there today. These demographic and other factors that we mentioned here, how important they are, the changes taking place in your local marketplace. Understand the real drivers of your member experience. We hear a lot of emotional decision making in the club, and where people tell us this is what members care about, that's what they care about. Generally, they're speaking really off the hip and not so much by data. Reaffirm and pursue your aspirations. This is not a time to go small. This is not a time to back off. It's time to stay true to your values. Think about quality, consistency, and value in anything you do as a club, not cost cutting, not cutting back, not diminishing the experience, delivering the best experience you can, even if it's on a limited basis and then on a more accelerated basis. You know, there's great direction here from Roy Disney. It's not hard to make decisions when you know what your values are. This is a time to think about those and act in concert with those, not move away from them. We see summer of 2020. Obviously, your mantra is going to be safety first, protection of your staff and your members as we move into this. I think in a lot of ways where we got into this, it was gradual dialing back of services and programs will unwind in the same manner, from going back up the ladder to takeout services. Again, a big emphasis certainly in our country club market is to emphasize and utilize your outside spaces. We might begin serving then a few nights of meals in smaller dining rooms, taking away some tables and providing some limiting services. And again, use this time off to revise and streamline your program. We're already in a world where high-end casual was the focus. Come back really directed and really effective in that regard, and eventually we may ramp up to full service activities. Do what you're doing well as you can, and this might begin again with some modified golf and some limited fitness traffic, those sorts of things. Seasonal clubs, their challenge will be compounded by finding staff that obviously many of our international staff may now gone. You may have some opportunities in the local market that were not previously available to you. Now those can come open to you as unemployment changes locally. But again, think about what you can do effectively there and realize some of those limits, but also again do it as well as you can in any way that any area that you are operating. I think one of the things to also think about here is continue this virtual club. Many of us are now connected to our clubs and frankly the rest of the world, right, through the internet, through screens and all those sorts of things. Those will continue, and that will not go away in 2020, and I would submit probably forever as we do that. And so continue to think about going forward using the internet to increase engagement with existing and even potential members going ahead. Video messaging to really personalize what you're telling your members, virtual tours of the club that can be offered, all sorts of events that you're offering now. I know we're seeing so many live streams and cooking tutorials, golf professional sending videos of golf tips, fitness classes led by the club, online bridge. Again, our senior members who may be reluctant to come out to the club, we can connect them through online bridge programs. I was talking to Tim Musil yesterday out at the Olympic Club. They were having a member who was an author facilitated by a radio personality, was broadcasting a book signing and book club report to some 700 members last night at the club. And of course, holding online meetings, even webcasting annual meetings and those sorts of things. So again, in a temporary way, we've tried to connect to our members through the virtual club. That virtual club will continue, and we would encourage you to double down on that effort as we go back and start to operate. There's an old maxim in marketing that you market your way out of recession. Out of this great cessation of activities, we would encourage you to research your way out of the environment that we're in today. Research is always a two-way street. This will give you an opportunity to reconnect with your members, show that you care, short, targeted surveys that you can develop and run. What kind of things are they expecting that out of the club that could make them more comfortable? How are we going to win them back? What level of anxiety and uncertainty do they have today? And again, what sort of steps can we take as a club to re-engage with them and to invite them out to the club and get them involved? And we think that will be very much your friend in this program. Additionally, it'll also be time for a bit of a facility refresh for our clubs. Our facilities can be used in many different ways, as we see, from whether that's the casual cafe and drop-in spaces, expanded outdoor areas, the ability for remote work and all those sorts of things. Take a time to go through a bit of a refresh plan idea of looking at your club. I think many of us are going to have big, vast ballroom and event spaces that are not going to be very popular really till sometime in 2021. And so can those spaces be used in ways to help you serve members today, to spread people out, to service them at the club? Think about your entries. I think you're going to want to have a re-emphasis of a presence at the entrance coming to the club through a receptionist, and again, the idea of control and safety to emphasize with that. So as we begin to look to the future, we would say that it's important for leaders of clubs today to use innovative thinking to identify new ways to make your club a vehicle for this post-COVID life. We have to first manage to the 2020 realities, kind of the slow deployment of services that we'll see, we believe, through the summer season here. Use that time to research and experiment to identify longer-term shifts in member sentiment and behaviors will be a part of it, and refresh your plans. The world has indeed changed, so what your plans were 6 and 9 months ago really have to change with that. But as you do that, you reset to plan for this new and different future. We have to stay true to our core values in doing that, and don't adopt short-term actions that undermine the principles of being a private club, and re-emphasizing that notion of what we're doing, we're going to do in a quality way. We're going to do it consistently, and we're going to do it in a way that provides significant value to our membership. So with that, I will turn it over to Ray Cronin.
Thank you, Frank. That was tremendous, I have to say. Really, really insightful. I hope I can keep up on my end. I think, Frank and I talked a little bit in preparation for the webinar, but we really didn't coordinate the creation of our slides, although it's amazing how much overlap there is. Frank and McMahon come at it from a perspective, and we come at it from another perspective, mainly the financial perspective. But I would say the theme of what Frank said and what I hope to communicate, basically right on the same point. It's interesting. I love watching the stock market, and it's interesting to see the ups and downs in the stock market as the daily news and the virus changes. And I think that the key, one of the key messages, obviously, Frank said, is that there is a future in sight. The future might be different, and it's an opportunity. In the end, this is the whole point. It's clearly an opportunity. It's definitely an opportunity for our industry. And Frank did a great job of citing why. The way we're looking at it is we are looking at this situation in reference to the last recession in 2009 and the meltdown in 2007 and 2008. And the decisions that clubs made, as Frank cited, during and after that recession. And it's clear from the data that the decisions that were made in boardrooms had a much more profound impact on the outcome than the actual recession itself. And we're trying, I think NCA, other organizations, certainly McMahon Group, Club Benchmarking, everyone on this webinar, we're all trying to come together to make sure that we don't overreact, and that we try like heck to view this like life is, as adversity, but we have to fight through it, and we have to try to make us stronger. What doesn't kill us will make us stronger. So the virus crisis, and we're in the middle of it clearly, is an issue, but it's not the issue. I would suggest it's a tactical issue, not a strategic issue, although Frank's theme and ours overlap in the sense that if we view it properly, we can in the short term react tactically, but use the crisis as an opportunity to make strategic modifications as we look forward. So we have written a white paper and disseminated. I think, maybe folks on the webinar have seen it. Those that haven't can, but the main theme of it is that we tried to put together a framework from a financial perspective and an operational perspective to address the crisis in a thoughtful manner. And the main point is we shouldn't make decisions that have long-term consequences while we're in the midst of this crisis with short-term information. All we have to do is look at the ups and downs of the stock market and just the vagaries of the government, the Treasury Department, as Joe said earlier, the amount of money that's being injected into the economy is changing day by day. The way it's being injected in the economy is changing day by day. So we need to get through the immediate crisis situation to have more clarity of information before we make decisions that have long-term consequences. We counsel that we shouldn't be cutting the initiation fee now, anticipating that we'll need more members because of attrition or because not as many members will be knocking on club doors when it's May or June, when people typically join clubs in let's say the northern 2/3 of the country. And certainly resisting hacking away at 2020 operating and capital budgets, expecting doomsday. We kind of see that happening. We kind of, I'll get into this in a minute, look at the way clubs entered the crisis. We bucket the industry into 3 buckets. Those that entered the crisis with a strong balance sheet, a moderate or average balance sheet, and a weak balance sheet. What you tend to see in clubs is the clubs that have weak balance sheets have them for a reason. They have a culture of what we refer to as operational governance. They're very tactical, and they don't have a long-term vision, as Frank cited very clearly what a long-term vision would look like in terms of planning. So we're trying to counsel clubs. Let's just get to the end of April. Maybe it's the middle of May. It's another 4, 5, 6 weeks before we really start doing major surgery on anything. In any decision that's made, we have to have context. I was reading an article about the virus, and there was a line in it which I have adopted now. I love it. But what we try to do is we try to use data to provide context. When we started the company, I always felt before, and the reason I had the thought to start the company is I always felt in the boardroom of my club when we were discussing things and making decisions, I literally felt claustrophobic. I'm not exaggerating. I always felt we talked about what's happening at the club without considering, let's say, the outside world. And, context is so critical in making any decisions. So clubs must understand as they make decisions in relation to this crisis, why they are where they were when they came into the crisis. And the strong clubs must continue to do things they were doing and not change that. And the weak clubs have to begin to think differently. Otherwise, they'll end up, we know where the movie's going to end. I'll get into it in a minute, but I'll tie this decision-making back to the last recession, as Frank did. Obviously, clubs with stronger balance sheets are better able to absorb the impact of the shutdown than clubs with weak balance sheets. We just suggest that there's 3 frameworks in terms of really even budgeting, finance, considering the financial impact. There's 3 buckets that we advise clubs to embrace for 2020. The first bucket is until the shutdown ends. So the shutdown began in different time frames, but basically in mid-March to a couple of weeks, maybe the end of March, and it's going to loosen up sometime between the end of April and likely maybe the end of May, but probably more like the middle of May. That's one time frame. So that's the shutdown time frame. The next time frame is the May and June time frame, and then the final time frame is the second half of the year. For some context, context is important. Here's a little research that I did relating back. I didn't have to go back and get all the recessions back to World War II. I took a 40-year period. I graduated from college in 1980. When I graduated in 1980, we were in the throes of one of the worst recessions that we had been in since the Depression at that point in time. So these are the recessions that had occurred in that last 40-year period. So I'm not going to read the whole list, but you notice on the far right column, the GDP decline. The Great Recession was obviously the worst since the Depression, pretty acute. The others, more marginal. By the way, there's an organization based in Cambridge, Mass, called the National Bureau of Economic Research. It's a not-for-profit, and it's the organization that determines when a recession started, when a recession ended, and tracks the metrics that relate to the recession. So we don't even know yet. We assume we're in a recession. It's likely, but the basic definition of a recession is 2 quarters of contraction and 2 sequential quarters of traction in GDP. So let's assume that we've started a recession because of the virus. We had the longest post-recession expansion, I believe, in the history of the country coming into this recession. We don't know where it'll end. We don't know how long it'll be, and we don't know what the GDP decline will be. But I'll say this. We've tracked at Club Benchmarking 12 banks and economists' prognostications. They're all over the map in terms of GDP in Q2 and Q3. But they all pretty much come together for the total year of 2020. The basic projections amongst those 12 prognosticators is that for 2020, when all is said and done, the economy will be somewhere between flat year over year to down 2%. So that's kind of like where all the forecasts converge, but they're very different leading in. So if you go back to January of 80, there's been 483 months since January of 1980. In 56 of those months, we were in recession, not including where we'll end up after this. That's through March of this year. That's 12%. So 12% of the time over a 40-year period, the country has been in recession, obviously a marginal amount of time. And I'd say this, when you think of the context that I'm proposing is important for decision-making and framing the decisions that clubs make now, what's had more of an impact on a club's financial position entering this crisis? The 12% of the time the country was in recession, or the decisions made in 483 board meetings since 1980? I think we all, it's a rhetorical question, but I think we all know it's the second that has a much more profound impact on clubs' situations today than the recessions did. We've done estimates of what the shutdown how it will impact clubs financially. We did the estimates for the 2 basic segments in the industry, clubs that have golf and clubs that don't have golf. I'm not going to, that's just the spreadsheet I use to do the estimates. Our estimates are that a 1-month shutdown, and we estimated it, kind of tried to blend the regionals. Of course, if you're in Florida or Arizona, the impact is at peak season. But if you're in Minnesota or Boston or Maine, it's not at peak season yet. So we tried to blend the fact that, because we didn't want to, go at it by region. It's too much in too short of a time work to do. But ultimately, the bottom line, our estimate is for a 4-week shutdown of the club, that the impact financially is going to be somewhere between 3.5% and 4.5% of dues revenue, annual dues revenue. So every club, I've now vetted this, not against 100 clubs, but probably against 30 or 40 clubs who I've had conversations with recently, last couple of weeks, asking them what their analysis showed, what they thought the financial impact at their own club would be, and relating it back to dues. I came up with this independently, but I've tried to confirm it when I have those conversations. It seems pretty rational. 4 weeks, 3.5% to 4.5%. If it ends up being 8 weeks, you could double it. Let's say 7 and 9% of the dues revenue. The point is, it's marginal. The shutdown's impact financially is marginal. It's not in and of itself. There are clubs that were teetering on the edge entering the recession. We've already had one go down in Massachusetts since the shutdown, but they were probably going to go down anyway. It just accelerated a few months. But for the most part, the impact of the shutdown financially is marginal. The most important issue or point of context is where the club was, your club was, entering the crisis. So we can use data to segment the industry into three buckets. A quarter of the industry entering this crisis is growing what we say purposefully, which I love Frank's terms, quality, consistency, value. We have a metric that we believe is the most important key performance indicator financially for any private club or literally every private club, and that's net worth over time. Half of the club, which basically means members' equity. In any business, equity is an important consideration in the balance sheet, obviously. Half of the clubs in the country have shrunk in inflation-adjusted dollars. Their members' equity has shrunk since 2006. We gathered the data from over 600 clubs for every single year since 2006, pretty major effort. The reason we picked 2006 is because we wanted to get the starting point from prior to the last recession. So half of the clubs in the industry, based on that data sample, which we think is statistically significant, have shrunk in inflation-adjusted dollars since 2006. A quarter of the industry, the upper quartile, has grown members' equity at a compounded annual growth rate of 5% or more. So that's the quarter of the industry that we refer to as growing purposefully. They have a full membership or very close to full membership roster. They have quality and consistency and value over time, to use Frank's words. They have compelling services and amenities that drive a compelling member experience. And it's those fundamentals that have driven their balance sheets to be strong. Their assets are fresh and up to date. They have adequate cash reserves. Their members tend to think more like owners, and they take pride in their club than they do like customers. And their focus of governance tends to be on making the club better. These are the boardrooms where the discussion is, what are we going to do to make it even better? What are we going to do to, I think some of them can have a tendency to get stuck in operational governance, but mainly they're oriented towards strategic governance. On the other end of the spectrum, a quarter of the clubs are shrinking in absolute dollars. Forget inflation-adjusted dollars. A quarter of the clubs have members' equity in 2019, ending 2019, that is less in absolute dollars than it was at 2006. Those clubs have too few members as a result of a weak member experience to fund the club properly. They have narrow breadth of services and amenities, and the services and amenities they offer are really lackluster or pedestrian. They have weak balance sheets as evidenced by declining net worth. They have significant deferred capital investment as evidenced by a metric I'll show in a minute. And they don't have cash reserves that'll get them through easily through the 4 to 8 week shutdown. They'll make it, most of them, but it's not as easy. Those clubs tend to elevate operational governance over strategic governance, as Frank said in the last recession, and we would validate or completely support this thesis based on our data, that those are the clubs that focus on cost, not value, and generally their members tend to think like customers, not owners. And then you get the other half of the industry, which starts at the 25th percentile and goes to the 75th percentile, and by definition means is having just a bit more than shrinking in terms of growth, all the way up to moderate growth. So I characterize it as going sideways to moderate growth. They have barely adequate to an adequate number of members. They have barely acceptable to an acceptable member experience. They're somewhere between lackluster and above average services and amenities. Their balance sheets tend to be average. Their net worth is flat to growing slightly in real dollars. They have some deferred capital investment, and they have some cash reserves. They bounce between operational governance to strategic governance, and maybe they have a mix of customers who think like owners and a mix of members who think both like owners and customers. So the key for this period of time between the end of April 1st is just keep things focused on the financial impact of the shutdown. Clubs can absorb it. Don't panic. The second part, May and June, the key is to understand what your membership engine strength is and make sure we track the member intake or attrition as we come out of the shutdown. There's certain very clear financial best practices that we have discovered through our analysis and research. I'll go through these, and I'm not going to read every line. I'm pausing so people can read it, but let's take a look at it. You know, in first off, one thing is the balance sheet, members' equity is ultimately a result of capital income. It's not a result of the operations and the operating ledger. It's very clear when you look at the initiation fee across the industry. This is for clubs with golf. I'll show clubs without golf in a minute. You can see just by looking at the distribution here, there's clearly these three buckets that I just portrayed earlier. You know, a quarter of the clubs with golf have an initiation fee of $10,000 or less. The median is 30, and the 75th percentile is about $67,000, $68,000. By the way, all three of those breakpoints, quartile breakpoints, from about 5 years ago, they were flat for the first 5 years subsequent to the prior recession. In the last 5 years, we've seen a marginally consistent uptick in the initiation fee. If you went back about 5 years, it'd be $7,500, $25,000, and probably about $60,000. So there's been a slight uptick. But when you relate where a club's initiation fee falls into certain other key performance indicators, like how many members do we have, how do we treat F&B? Do we treat it as an amenity or a profit center? How broad are our services and amenities, as evidenced by the amount of money we allocate operationally to non-golf sports? And then our balance sheet, members' equity, which is that measure. And then finally, we have a metric that is it's a very easy metric to use to assess the state of the assets in a club. It's called the net to gross property, plant, and equipment ratio. I'm not going to read all these numbers, but for those that can see the slide, I assume you can see clearly that the clubs with higher initiation fees have more members. They treat F&B more like a profit center than an amenity than a profit center. They invest more broadly in services and amenities beyond golf, and their members' equity reflects tremendously the variation in initiation fee. In the bottom row, they also have more updated and fresh asset bases. So we can't solve a member experience or value problem at a club by cutting price. It doesn't work. We can't drop the initiation fee and think we're going to solve a problem. We have to invest in the member experience. Understanding this pattern that we see here is critical. It's the same data, but it's the initiation fee data for clubs without golf. Clubs without golf generally have lower initiation fees. They also generally have more members, but you can see the pattern's the same. As you move across, as the initiation fee increases, you can see the members' equity is increasing. You can see the asset base, as evidenced by the net to gross property, plant, and equipment ratio, is more up to date and fresh. You can see the F&B subsidy, which is indicative of, as you move to the right, treating F&B as an amenity, not a profit center. And you can see the breadth of services and amenities, as evidenced by the amount of money allocated to non-golf sports, which, and I use the same term, it's probably got to change it. It's really non-yachting or non-dining sports and amenities. It's basically all the fitness and wellness and the other things like that. When the last meltdown occurred, or the last recession, our estimate is that half the clubs in the country either lowered their initiation fee or many of them just eliminated it. It doesn't work. One of the things that the data shows very clearly is that the amount of churn that a club has is very much related to the initiation fee. In the clubs with the lowest churn, the lower quartile on this chart, this is for clubs with golf, the median initiation fee is $50,000. In the clubs with the highest churn, the upper quartile, the median initiation fee is $10,000. The churn in that quartile is greater than 9%, meaning almost 10% of the members are leaving every year. On the lower quartile, it's 3%. If you translate that into reality, a membership churn of 3% means you're replacing your membership every 33 years, fully, an entire membership. If you have a membership churn of 10%, it means you have to replace your membership every 10 years. That's a profound difference. Obviously causes all sorts of issues. So a lower initiation fee might in the short term yield more members, but it will not over time increase your membership levels. It's just going to cause a revolving door. And what happens is it tends to attract people with little skin in the game, obviously, who tend to be the members who think more like customers than they like owners. This is the same data for clubs without golf, and the data shows very clearly the same exact pattern. So we can't cut price to solve a value problem. Now, some of the logic that occurs, and we're presenting this data, this is now when we're coming out of this shutdown, and when it's May and June, if there's stress on prospective members knocking on the door, we're presenting this data in these concepts to help resist the temptation to come up with a short-term solution to a long-term problem, which is cutting price. Doesn't work. It actually feeds, frankly, momentum going in the wrong direction. But there's a thesis behind cutting the initiation fee. And the thesis is not correct according to the data. It's wrong. The only reason we would cut the initiation fee is because we think we'll have more members. Well, if that thesis is true, then the clubs with the lowest initiation fees should have the most members, and the clubs with the highest initiation fees should have the lowest members. And the same goes for dues, how much a member pays to belong to the club. If we cut dues or we give dues deals, quote unquote, 2-for-1s, all that stuff we know exists in the industry, the thesis behind that would be if we have lower dues, we'll have more members, and if we have higher dues, we'll have less members. But the data shows the exact opposite. This is the initiation fee against how much members pay and how many members there are, full member equivalents, and you can clearly see the clubs with the lowest dues and the lowest initiation fees have the least members, and the clubs with the highest initiation fees and the highest dues have the most members. To me, the data demonstrates an extremely clear pattern, which is, Frank said so well, we're in the luxury portion of the hospitality business. Clubs don't compete on price, they compete on value. The clubs that are struggling or they have the weak membership engines, and I spent 10 years on my own club's board, and I've had these discussions in the real world of a real boardroom over a long period of time. I spent 3 years as president. I understand this stuff not from just a theoretical or data standpoint. I understand it from the reality of sitting in the boardroom every month and the reality of going out and discussing decisions that were made in the boardroom with members in the grill room. It's not easy stuff. I'm not trying to diminish or negate the difficulty of this. But if we embrace the data, it's very clear that clubs compete on value, not price. So in those clubs where we need to increase our member counts and we want to strengthen the member intake, let's see if we can come up with answers that increase the value rather than decrease the price. I think of victory I love sports, the NFL, the NHL, the NBA. You think about the playoffs, you think about the teams that win the championships. Victory is always on the margin. It always comes down to, it depends on the sport, but let's say 3 or 4 plays during the game. And on the margin is where success or failure lies in any business. And on the margin, in the boardroom of clubs, if we're making a decision on increasing price or cutting costs, and increasing price in an effort to maintain or increase services and quality, we should always lean towards increasing value. We shouldn't lean towards cutting price because we know the data demonstrates it won't work. Another way of looking at this is the operating expense. So if we cut expenses, there's a thesis behind that. If we're going to cut expenses, the thesis is if lower expenses, it'd be better than higher expenses. This shows the operating expenses. This is all 2019 data, by the way. We've gathered already from over 500 clubs. We continue to gather it, but we've already got all this data. So this is real fresh data. But if you look at the operating expenses across the spectrum, if the thesis that cutting costs is the right reaction in a crisis or any time in a club boardroom, and obviously I'm focusing on the 90% of the time we're not in recession instead of the 10% of the time we are. But if the thesis is that lower costs are better for a club, then the clubs with the lowest cost should be the healthiest, and the clubs with the highest cost should be the weakest. The data shows the exact opposite. The clubs with the highest cost, look at the initiation fee, look at the member count, and look at the dues. So I've combined, by the way, for the sake of expediency and time, both clubs with golf and without golf on these last two slides. This data demonstrates so clearly that clubs compete on value, not price. The increasing expenses is not a sign of inefficiency. We've done a significant analysis. At best, 7% of a club's overall expenses might be tied to efficiency. Clubs are a fixed cost business. It's clear. The reason expenses increase is because the clubs with the highest expense have the broadest services and amenities, the largest footprints. They have the better member experience. The clubs with the lowest expenses have narrow footprints, lackluster member experience, a pedestrian member experience, and that's the whole point, is obviously it's the member experience that drives the outcome. So when we're making decisions, whether it's in the throes of the shutdown or thereafter in May and June or in the second half of the year, please don't make a decision in your club boardroom without understanding which of those three buckets you entered the recession in or the crisis in. Did you have a strong membership engine and balance sheet or a weak membership engine and balance sheet? And the whole idea is if we're in the weak category, we're trying to get to the moderate category. If we're in the moderate category, we're trying to get into the strong category. We have data that shows clearly since the last recession, the market's not static. The market is dynamic, as every market is. There were clubs that exited the last recession in the strong bucket that are now in the weak bucket. And there were clubs that exited the last recession in the weak bucket that are now in the strong bucket, which is another demonstration of the point that is the decisions we make that have the impact, not the recession. We can move back and forth, and clubs will move back and forth. So just going back to the circle, the crisis is an issue. It's not the issue. The issue is the decisions we make and the way we make those decisions. And it's a tactical issue, not a strategic issue. But the decisions we make around member experience are strategic. And I think I'm finished. I don't know why it's got the same slides there, but I am finished.
Fair enough. Thank you to Frank and Ray for what it was a fantastic presentation, and I think very insightful and very very educational in terms of getting us focused in the right direction. And I know that some of the attendees have said that this is probably the most informative webinar that we've had in our series. So fantastic work. We're going to enter into a little period of question and answer, and I wanted to take the liberty as a moderator to ask the first question. And I think you both kind of touched on it a little bit, but and I'm kind of coming at this from the experience I have right now of being president of Mount Vernon Country Club and leading the board through what is clearly a very uncertain period. Clearly you have you don't want to be operational in terms of what your discussions are and that kind of thing. But it seems like it's almost impossible in the current environment not to be thinking about operations in the sense of, you need to make sure that the board is involved in the decision of, what services are going to be available, any further restrictions on members in terms of their access to the clubhouse or, the course, those types of things. So I almost feel like we're in a period right now because of, just being forced upon us where your board has to be operational right now. But the important thing is not to continue that operational mindset as things become clearer. Am I wrong in that?
No, I'd say you're right on the money there, Joe. And I think if we know that it is, and I hope I portrayed that correctly, that through the shutdown is a tactical time, it's an operational time, but we just limit the decisions to within that time frame. We know we're making operational decisions. We know we're making short-term decisions. We know we're making tactical decisions, and we're going to limit those decisions to the shutdown time frame. That's a very reasonable approach, no question about it. But frankly, the staff, the general manager, they're the ones that are going to, kind of drive that response. The board will obviously understand it, has to understand it, has to be informed, and certainly will support the staff, and the board may even add value in it with ideas. More people have better ideas than fewer people, without question. But the key is that the board's not, in the club in an operational manner, making these things, implementing these decisions. It's really the staff in the end.
Well, I think that's right, Ray. As Frank, I would add, it's just, I think, Joe, to your point, I would encourage the board that they don't start there. The board has that conversation, as we talked about, as to, and we see that, right? A lot of meetings where, the mission statement's present in the meeting and those kinds of things. The board, I would just encourage, spend some time talking about who we are and what we have been and aspire to be before you get into those tactical discussions. And frankly, through that lens, then task the executives to go out and come back with recommendations and really bounce it back and forth that way, rather than, because I think the board, if they start there in the operational realm, you're going to get into the things that Ray and I both talked about. It's going to be looking at how do we cut this and how do we cut that. It's just, I don't know. In 30 years of the club business, I've never quite figured out why very successful business people get on club boards, and when challenged, they immediately go to the cut modus, mindset versus saying the game has changed. How do we invest, reposition, whatever it is? How do we use that as an opportunity? So, so I would ask them first to reflect on, who we are, what's core, and those sorts of things, and then say to management, now understanding that, come back, paint the picture for us. How are we going to get this done? And then have them more involved in critiquing and tweaking rather than setting the table on that activity.
Mm-hmm. So really, it's making sure. I think what I'm hearing is it's really important to make sure that the decisions you're making now are short-term in duration and don't affect the long-term goal or plan or strategy of your club. So, we've had a question from one of the attendees about initiation fees and lowering initiation fees, and I think you guys covered that. But there was also sort of the add-on of, if you don't lower it, can you create programs to let new members pay over time, or let them walk away without a penalty, those kinds of things. How do those kinds of ideas play into what your strategies are that you talked about today?
Well, this is Frank. I would, sort of play those a bit slowly. Again, some of the assumptions that are in there, I could argue from the presentation today and the information and research we're getting, your club has become more valuable, not less valuable. Your club was one of the things your members could do in 2019, and frankly, getting their attention and getting the share of their time was one of our bigger challenges than anything else, because everybody was traveling around the world, and everybody, probably had more money than most of them ever experienced before, right? And so, now you are the place that they can go. Your member's not going to wake up in June and say, I want to go to the busiest restaurant in Chicago or New York or any of those places, or even here in St. Louis. They're going to tiptoe out into that. And so I don't think you have to sell yourself short. I think you have to convey, again, the value of this experience. We are going to offer that safe, secure home away from home for our members. And sure, can you spread that initiation fee out over time? I suppose. I see that work well. We are not in the cut mode at all, and don't think that's there. It's Ray's detailed within his data. That is a that's a false hope, and you're setting yourself up for failure in that mentality. It's about better telling your story and better emphasizing what it is that you do provide. And frankly, successful businesses are able to determine what their customer base is and should be, and rejects business that's not theirs. If somebody can't pay the initiation fee, that is minor in scope compared to what 8, 10, 12 years of membership are going to cost them in dues and usage. And so there's no sense in playing this game. We're going to get them in, and somehow they're going to, spend a lot of money around here. You've just changed the whole dynamic of the membership equation when you do that. So some people are going to walk away from that. They're not going to be your customers. But as Ray clearly shows, the clubs that have a justifiable and strong value proposition, they can charge what the market will bear to make that happen.
Mm-hmm. Yeah, I think that's a really insightful, perspective. And one of the things that, to your point about, looking longer term and emphasizing the value and the fact that clubs may emerge from this in a stronger position, something that we certainly tried to talk about, not only in the context of NCA, but also at Mount Vernon, about the club community. And the fact that we are a community, and we're focused on getting through this together, and we're going to emerge stronger, and connecting in that way, I think, is an important one to get people thinking long term. That things aren't always going to be this way, and that club is going to be there for you, one on the other side. So, Ray, did you want to add something?
I just Frank said it well. You said it well. I'd say the one thing in the question from the audience. We do track the data in terms of how many clubs allow financing of the initiation fee. I'm doing this off the top of my head. I think it's close to 70%, and they think the average duration was 38 months, something to that range. I can get the specifics. I'm sorry, I'm doing it off the top of my head, but it's a common practice. I think the data would suggest that it's an absolutely rational practice to allow people to pay that initiation fee over time. Some clubs charge an interest rate, some clubs don't. Some clubs charge an implied interest rate by, if you pay it over time, you pay a little bit more than if you would have paid it up front. So that's certainly a very plausible approach, especially for younger members. By the way, McMahon's research, as Frank said, and our research are exactly the same, that the average age of joining is 42. So if you're using the financing to entice younger families, beautiful, that's a great thing, no problem there. But cutting it, it's just not an answer that's going to provide the outcome that any club wants.
Mm-hmm. So I think looking at this from a different perspective, not necessarily the initiation fee, but the ongoing dues commitment. Obviously, the effects of these shutdowns are going to impact people in different ways, and members are going to be impacted in different ways. Some are going to have almost 100% of their or 100% of their revenue taken away if they're a business owner, that kind of thing. What sort of strategies do you think are useful for clubs to use in terms of helping members who might, be unable to pay or are facing some really financial difficulties?
Frank in his initial portion used the word forbearance, which I love. I reflect when this question comes up. I always reflect on my tenure on my own club's board, and I used to shake my head at the way some people approach it. Sometimes there's a kind of a macho approach in the boardroom. Of course, if you're on a club board for 10 years, there's going to be discussions you're going to have about members who are having financial troubles that are looking for forbearance. And I used to see the way various people would react to that. I saw on the macho side of the equation, it's like the attitude was something like this. And I believe, by the way, it's an ego thing. I will state that clearly. By the way, I think the ego thing is a problem generally in governance and clubs. But the macho approach is something like this. Hey, if they can't afford it, who cares? Let them go. And I used to think, well, I kind of think of the club as a place of camaraderie, a place of mutual support, as Frank said, well, a place of social networking, brothers and sisters. And it's kind of like if one of my family had trouble for some period of time with money, or a good friend, we've all done it. There probably isn't a person on the webinar that hasn't had that situation. And the natural instinct is to, I think a natural rational instinct is to lean towards helping and not pounding on someone if they're having difficulty. And most clubs charge some kind of interest on overdue accounts, which maybe that could even be considered in this particular time period, but certainly leaning towards trying to help. Now, there are obviously in society, it's a bell curve. There are people who would maybe take advantage. There are people who may never pay. I get that. It's part of business. Every business has a bad debt expense on their income statement. We understand that, but that's the exception in my view, not the rule in private clubs. And I'll tell you, when a club works with members and has forbearance, as Frank said, and that member gets through their crunch and they love the club and they get to stay in the club, do you think that they're a more loyal member or a less loyal member after? It seems to me common sense is, let's try to help our brothers and sisters while they need it. And yeah, you know what? 1 out of 8 times or something, we might get shortchanged as a result, but that's the cost of being in business. But 7 out of 8 times, we're probably going to have a more loyal owner than we would have if we didn't have forbearance.
Mm-hmm. Well, I think that's right. We're in an environment where things are off the charts, right? This is such an unusual environment when you look out there and find that, think about the dentist who has a very successful dental practice but can't practice right now, or the orthopedic doctor who had knee replacements lined up till the end of time and was counting that money every day in going through that. We're going to get back to having knee replacements and dental work, but we're not going to be doing it in April, May, June of 2020. So again, I think you can handle those well, have a good, the right kind of personal conversation with people. And, this is such since it was not an economic recession and that those people have no chance of coming back, this is an intentional cessation of economic activity. Where many good businesses are being impacted by this, and those franchises or whatever you want to call them, as I say, knee replacements are going to go on, and dental surgery is going to go on, but not for a little bit yet. So you take it under advisement, you have conversations. I think there's ways to get through that. Obviously, we're never advocating, just broad. I talked to a club yesterday, wanted to know if we'd help them send a communication about suspending everybody's dues. And I said, no, actually, we're not going to work on that communication because that's just not a rational business approach. But dealing with cases case by case basis, the rational approach in this marketplace. Think about how we get through July, and then after that, then you might go back to a more, normal course of events.
Mm-hmm. Yeah, I think those are good points. Getting into, I think maybe a little bit more of the nitty gritty in terms of what things look like on the other side. One attendee had a question about dining services and what sort of changes we might see on the other side of this, and specifically was asking about buffets and that kind of approach to dining. Frank?
Yeah, well, I certainly wouldn't start there. Again, as I tried to mention in my comments, I think you ramp up the way we ramp down, and so I'm here in Missouri. My club is doing takeout. I've talked with clubs this week that are doing takeout in gated community clubs and serving 100 covers a night in Rancho Mirage, Palm Springs, and areas like that right now. And so, I think you'll sort of walk back into it in that fashion. I think in ways this also gives you a chance to rethink, some of those sacred cows and practices that probably didn't make a whole lot of sense. In terms of a formal dining room that again the loud voices insisted that we need, despite serving 10 and 20 covers a night or whatever that may be. I think this gives you a chance to think about upscale casual dining. Think about limitations on your menu and do it again well. Do it with great concern for value and consistency, as we've mentioned here today. But also take the opportunity of the crisis to get out of some of these bad habits. As that's always a thought in clubs, right? What's a tradition and what's a bad habit? And I think there are some things in our food and beverage operations that can be cleaned up in this environment to move forward in that regard. Simpler is going to be better. Any operation that we have, we need to be able to do it safely and effectively. And so use those watchwords as a way to create something that you can do very well, and also that is really responsive to where we know where the broad market has gone. Look at Danny Meyer's comments, and he's been very much out there, very much out front in this whole crisis, and he's very much of that thinking today, and thinks that this is going to change fundamentally the style of dining people are looking for, and it's probably not going to be buffets.
Mm-hmm. Fair enough. Ray, do you want to add anything to that, or?
No, I think Frank is the expert on that count, and I'll leave it to him.
Fair enough. Good, very good comments there, Frank. Another question for you relates to innovations, and for a mid-tier club, are there certain innovations that you would emphasize for a mid-tier club? I know that gets kind of you almost kind of need to know what the situation on the ground is.
I'll say this, and McMahon Group is great at this as well, but I'll just throw this into the fray. One of the things, and I made this note earlier when Frank was speaking, one of the things that I love right now about what's going on, I get, as we all do, we're getting emails from associates, if we're managers, other managers, if we're board members, other board members in other clubs, or if we're in the business, other folks. But so we see a lot of this. One of the things that's inspiring is that it's classic response. Necessity is the mother of invention. We looked that up, and my wife and two daughters last night were talking about the virus, and we were trying to figure out who quoted that. We all guessed. The answer is Plato. They attribute it to. So it goes back a long way. But the innovation that I'm seeing is very inspiring. And one of the most inspiring things I've seen is David Bachman, which I think you're going to have a webinar tomorrow, Joe, on the connecting hospitals with clubs. What a, it frankly brings a tear to my eye. I'm not exaggerating. It's just so inspiring. But innovation is happening right now because it's necessary. One of the issues in this industry is innovation is lacking, frankly. We think so much inside a box. We have to shatter that box. There is so much opportunity. When we do board presentations, we have a slide in our presentation with about 50 ideas that we conceived in the brainstorming session in our office one day in about 2 hours. Just 50 ideas. Some of them might be off the wall when someone looks at it, especially those that are rigid in their thinking. But none of them are off the wall. They're all potentially real. I mean, as clubs, we can do so much more than we have. And I wonder if, and Frank, made great points in his initial presentation on this, and I'm sure he'll add to it after. But one of the things that's inspiring, and one of the things that can be an opportunity coming out of the crisis, is that we actually open up the box and we actually truly begin to innovate broadly in this industry, and that boards, going back to my tenure again, and Joe, you may also, although I think you're a very open-minded individual and an innovator as well, but one of the things I learned in the 120-plus board meetings I participated in at my club and in so many presentations and so many other board meetings is when an idea comes up, the first reaction tends to be, we can't do that. And that's the way the industry is because we're anchored more to what happened in the past than compelled to, what's going to happen in the future, compelled to, there's a good line real quick. I was trading texts the other night with a board member of a club I've been to recently in the Pacific Northwest. And we were talking about, it's a great club, but it's very much anchored in the past. And so we were talking about the crisis and its potential to cause change. And his response, which I'm going to use this line forever now, is his response was, progress at our clubs happens one funeral at a time. because of the all those older members that just don't want to change a damn thing. And what a great line, huh? That's something. But it's not. In any case, we need to innovate. Let's use this crisis as an opportunity to truly drive open-minded, open-ended innovation. Most businesses are not afraid to try something new. There's a concept that exists in startups. I love startups. I've done a bunch of them. And the concept is called fail forward fast. And the idea behind it is don't be afraid to try something new. If it works, that's great. If it doesn't work, figure it out and get out of it fast and go on to the next thing. And that's a pretty good message, I believe, for clubs in general. Let's use the crisis as an opportunity to really stimulate innovation in this industry.
Mm-hmm. Yeah, and I would add to that, Joe, I would think that, may not be first and foremost in the category of innovation, but you talk about mid-tier, and so let's assume that the club is on that left side of Ray's scatter chart there, where we see that that 25% or so that rely on a lot of outside business and those sorts of things. So I think the first thing those clubs can do to innovate is really double down on their member focus. We just see so much distraction by these clubs that think outside groups are going to pay for their fun. Members pay for the fun of the club. They pay for the service of the club. They pay dues that are the financial engine of the club. And so make it rewarding to those folks. And this be the time to break those bonds of trying to chase, nickel and dime and penny banquet business and all these other kinds of things that we think are some sort of salvation. And all they're doing is distracting our staff from serving our members. They're overcrowding the place. And at the end of the day, how much more money do you really have? So, first and foremost, I would use it as a method as an environment to think about that business model. And again, every club that gets in trouble, I find they want to reject the notion that they're a private club. They want to cut the initiation fee because they say, well, that'll make it cheaper and let all these other people in. Well, there's no there, right? We deal with the 1% and 2%ers. Price yourself and position yourself to deal with the 1% and 2%ers, and don't try and kid yourself that there's some market below that you're going to be able to draw in. It's just not who we are. And if that's not the case, then frankly your club doesn't have an addressable market. You've got a whole different thing to world to and reality to deal with as you do that. So first, I would use it as an environment to really focus on the membership. And again, as I said earlier, I think, there's going to be some pretty empty banquet rooms and things like that you can work with. The other innovation, and simple and easy to do, use your outside spaces as leverage. Our surveys continually show that members value outside dining in season, whatever your season is. They value that more than anything else that we can offer. And we can put people in really great settings and have fun, and by their very nature of being outside, they indicate a level of simplicity that we can fulfill. And so you can adjust the menus, you can adjust the service and everything else to deal with that. And again, strip away kind of the pretense and the formality, and you've got to have a jacket on and all of those kinds of things, and focus on that fun and family and community and those aspects of it. The other simple games that are popular today, whether it's the bocce or the pickleball or all those kinds of things, these are easy, quick things that you can do that are that build community. We do those things to draw people together, gather together, and have fun with each other. And I think those things are again going to be in vogue, and things that we can do safely and such for our members today. But I'd encourage first and foremost, get out of this misalignment, get out of these thinking about the commercial activities of the club. Focus on your members and give them value so they'll pay another $5 or $10 a month or whatever it is that we need over time to really drive the club to sustainability and success.
I think that's a great point. And one of the things that erodes when you do those kinds of things is the very thing that is the special sauce of a private club, and that is the member experience. So, and I guess to that point, given the position we're in right now, there might be opportunities to look at how do you enhance that member experience when we're able to get back into a fully operational mode. Is there anything in terms of the staff of the club that they could be doing to, focus on enhancing that membership experience that people are going to be so craving when things open back up again?
Well, this is Frank. I would actually again use that staff as a marketing opportunity. We talk about the obvious of golf professionals and others communicating with the membership and the environment now, but I think you also want to take this time to remind members of how the favorite bartender is doing or the server is doing. Many members, their closest connection to their club is their staff, not necessarily other members. They may have a handful of other members that are their closest friends in life, but the engagement and the relationship members have with staff at the club is extraordinary, and extraordinary in the hospitality business. So as I say, you've got to be very careful with these furloughs and everything else, that when the members come back and, Susie Q, the favorite bartender, is gone, or server or whatever, that would be, that's going to be a loss and an erosion of what a club really stands for. So I think what you can do with that staff is make sure, if we're committed to keeping them and being involved in the club, making sure that they're part of that messaging going forward as to why you're going to want to come back to this club, why it's such a special place, and Chris the bartender's waiting for you to come back, and all those sorts of things. And your staff is often a hidden tool in this, and I think often underplayed as to how strong the emotions are around them and the relationship to the staff, and all the costs that you would incur by furloughing those people, retraining those people, all building up that same sort of network is a long, tough slog. And so I would emphasize the staff as a tool in our strengths and our ability to retain members and to encourage them to coming back to the club.
Ray, any thoughts you want to add?
I think Frank said it perfectly. I will, if I may, Joe. I just got the actual data. I was kind of close on one point and not on the other. On the financing, it's a sample of about 160 clubs. 54% allow financing, and the average duration is 3.3 years. I thought I said 34 months, so it's a little bit longer.
Mm-hmm. Frank, I think that you really hit on something there in terms of the connection members feel towards the club and the staff. Many clubs have had to make those difficult decisions to let some of their staff, furlough or lay them off. But I'm curious, is there potential value even? I mean, I think you want to maintain some connection with those employees, even if you've had to separate for a short period of time. I know that we're facing this at Mount Vernon, but is there a way that you can engage the staff that may have been furloughed, to check in with them? Any ideas around that?
Well, I'm not a labor attorney, and I think you need some advice. I know there are some pretty some rules that you need to pay attention to in that regard. And so I think you need to, obviously, as always, first and foremost, follow those and see what options you have. If options are open to you, I think, again, you want to emphasize that and again, encourage them that you're looking to have them back and what role they play. Right. And again, build up maintain that relationship and keep people excited for when they can come back. But I think some employment rules need to be considered in that outreach.
Mm-hmm. Yeah, I agree, and I know we've started some online virtual cooking classes and virtual golf lessons, virtual wine tastings, those kinds of things, and they're selling out. I mean, and we've had to add, events to meet the demand there, and the reaction members have to seeing the staff and continuing to have that interaction, albeit virtual, is really a remarkable thing.
Oh, that's awesome.
One question for, I guess, Frank, and I'm not sure we're necessarily going to have any answers here, but what sort of effects do you see on aquatic activities, as we emerge from this? And I think that's really kind of centered in more of almost a medical, clinical kind of situation in terms of, where are we at with the virus and potential spread and, that environment. But any thoughts on that?
Well, I think that's right. It's going to be interesting to see. I don't know yet. I haven't had a lot of focus on that just because we've been in the period we're in, and many of the club pools have been operating in Sunbelt clubs, which is a sort of a different environment. It's going to be interesting to see what the family swim environment is this year. It'd be tough to visualize swim teams and swim meets and those kinds of things happening anytime soon. I think you're going to have to break the groups up at best, and again practice some distancing aspects to it. I don't know the aspects of the chlorine and the water and what that does with any of this. Something to think about. Yeah, so we're going to have to look for medical guidance there and do that. It'll be a interesting piece of how we deal with the 2020 summer season in most of our northern clubs, and a little bit of an open question at the moment.
Mm-hmm. Ray, I want to get you back into the conversation here with a question from one of the attendees, and it refers back to one of your slides and looking back at the first 25% bucket of clubs, and the question is, how do you best improve the board decision making when a club is in that first 25% bucket?
It might sound a biased answer, but I honestly believe, and frankly, I've kind of lived through it. You can't do it without data. You need data to align people. Otherwise, it's just the person with the strongest will and the loudest voice. And frankly, to my experience, that has led many clubs astray. I've been dealing with the club over the last 3 or 4 days, and boy, am I seeing that as clear as a bell right now. Very strong-willed, very successful, and I mean very successful with a capital V-E-R-Y, business person, but very strong-willed and opinionated. Doesn't really know clubs well, and you can just see how it can result in problems. And I think the only way to overcome it, in my view, frankly, it's why we started the company. I really believe that data drives alignment. I've observed in my time in board meetings, both in my own club and many others, because I get to sit through a lot of board meetings waiting to do presentations, and so I've seen hundreds of other clubs and board meetings. If you put a clock above the head, the average club's got 11 people on the board. If you put a clock above everyone's head, and it tallied the amount of time particular people speak, it follows the 80-20 rule. To my observation, 20% of the board members speak 80% of the time. They tend to be board members who don't ask questions. They make definitive statements, whether they're incorrect or correct, without a factual basis. And they tend to lead the dialogue in a direction. And what we found is when data's on the table, it gives the other 20% of the board, who tend to be more introspective and more objective and more questioning in their manner, more knowledge-seeking, more data-seeking, trying to be objective, it gives them the ammunition to hold ground or speak up in the face of the strong-willed board member. So data drives alignment. Data gives the folks that are not as strong-willed a foundation from which to make very rational queries, and data can help lead the board in the right direction and overcome that opinion-based view. That's my answer to that question.
Mm-hmm.
Yeah, I think it's a great answer, Ray, and what Ray and his team have done with the financial data for the club world we've all learned from it, and we've all gotten better as an industry by the work that's been done there, and been around clubs a long time and learn something every time we go through those charts and think about those things. At McMahon, we play the other side of the ledger, right? Our data tends to be on the consumer side, the member side. What do they want? And I hear the same kind of things Ray hears. He might hear it about, well, this is what really drives our business, and of course it's not. On the other side, we'll hear about, well, this is what's important to our members, and this is what people really want. And again, it's often the macho golf guys and all these kinds of things that you're hearing is that's the only reason the club exists or whatever. And what we know is the people belong to clubs because they like other people. And it's about community, and food and beverage actually leads the way because it is the most communal of activities that we offer at the club. And all good conversations and relationships happen around that. Everybody eats, right? You can go on and on about all that. And yet, they're sitting in the boardroom pounding the table about, why do we lose this or lose that amount of money on the F&B operation? Again, just a misunderstanding about what's important to the consumer, or on the other side, a misunderstanding about what really drives their business. And so data is the answer on both sides. What do your members really want? A clear picture of the membership, what's important to them, what's working. And, certainly in our research, we spend a lot of our time looking at folks on the younger end of the demographic scale, and those who've joined the club in the last 5 years. Those are your most important categories to look at. New and younger members get you new and younger members. It's that simple.
Mm-hmm.
And so you really have to look at that group, understand that group. And again, in the club world, we hear a lot of, tradition. Well, we've either never done it that way, or we don't like the way they dress, or whatever it may be. And the reality is that's who they are, and they're not really going to conform to your world. They can do some of that, of course, but not all of it. And, so thinking about family, thinking about the role of women, all those things, and having data around that. Our data still shows women still feel like they can't get on the golf course at the right time, and all those kinds of things. And yet, the boardroom's sitting there thinking about, when's the next men's golf event? It's just sometimes just drives you crazy, really.
Mm-hmm. Well, I think that's a good place to wrap it up. I think we've gone over our allotted time, but there was so much insight and such great material there. I didn't want to cut it off too early. And a great conversation after the presentations. Just want to thank Frank and Ray again for joining us today and sharing their expertise and their knowledge with us. So with that, I'm going to turn it back over to my CEO, the inestimable Henry Wallmeyer.
Great. Thank you very much, Joe. I appreciate that. And thank you, Frank and Ray. Tremendous insight, tremendous information. A lot of great stuff coming out of there. I'm looking forward to implementing those as we turn the corner here on this COVID-19. Just to let everybody know, because we saw a lot of questions come through, the slides will be available within 24 hours on our Coronavirus Resource Center. They'll be up there along with the other previous 12 webinars that we've done since the very first one that we did on March 16th. So it's a pretty amazing feat that we've done 13 webinars since then, and we're not done for the week. As Ray mentioned, tomorrow's webinar is an opportunity to see how you and your members can help out your local hospital with the most critical items and resources that they need. David Bachman, who is the general manager at the Springbrook Country Club, started this, and now with the help of Rob Goulet, who is a senior advisor to Ernie Els, they are leading the effort to take it nationwide. So I hope you can join us for that. And just as a side note, very interesting note, David Bachman and Ernie Els will be on Fox News tomorrow morning at 7:25 Eastern, talking about this initiative and also shedding a great positive light on clubs and what clubs are doing. So hopefully you'll be able to watch that as well as participate in our webinar tomorrow. So thank you very much. Please let us know how we can assist you here at the National Club Association. The team is willing and able, and we can't help you unless unless we know what you need help on. So reach out to us if we can be of assistance, and we look forward to seeing you tomorrow. Thank you so much. Have a great rest of your day.
Thank you.